Hey, what's up guys, welcome back to the channel. In this video I want to address the fear that we're seeing in this stock market right now and give you guys as the retail investor some hope about buying stocks in this kind of rough environment, and why personally I don't think the insane amount of fear we're seeing around interest rates is really going to affect the long-term opportunity of our favorite stocks. There's a very simple macroeconomic principle that shows us that interest rates and inflation in the short term don't really affect the long-term growth of stocks. And unfortunately, I'm seeing a lot of people in the short term really take these macroeconomic policies to hand and make their long-term wealth-based investment decisions based on these very short-term things. So that is exactly what I want to address in this video, and I'm going to show you guys some critical data about the macroeconomic valuation of the current market as well. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing we're going to start off by is addressing one of the most prominent investors in the stock market coming out and saying that he does see a strong buying opportunity. Ron Barron, who is the portfolio manager of one of the biggest hedge funds in the country, who has also been in the market for over 50 years, has recently said that this sell-off in the S&P 500 is a generational buying opportunity. Now, why is that the case? Well, I think he's seeing the exact thing that most big money people in the market are seeing today, except they're just not outsiding their opinions, meaning they're not expressing their opinions on the open media, except they do think that the market is in a pretty good deal right now. Now, yes, the market can always go lower, but as an investor, our job is not to predict how low the market is going to go. Our job is to simply buy assets as they're falling because we're getting a good deal as compared to where those assets were about a year ago. Even about a year ago, we saw so much bullish momentum in the market, and everybody on Twitter and social media was telling you to buy stocks. But now that the market has gone down, people are now telling you to not buy those same stocks, right? What gives? The simple answer is that people use price to determine their investment thesis. Just because the market's going down, everybody's now bearish, right? Instead, a year ago with GameStop and AMC, everybody was bullish because the price was going up. And the same people that were telling you to buy AMC and GameStop and all these EV SPACs and stuff that were going public in 2021 and all these crypto coins like Dogecoin and Shiba Inu are now all of a sudden macroeconomic experts, and they're telling you to sell stocks because the market is going to go even lower. Well, that right there is exactly what we call a herd mentality. And Ron Barron is exactly the kind of person you want to be listening to because he's going against the herd. I've been also saying this. I don't know when the bottom's going to be. All I know is I don't want to be in the same side of the boat where all the retail investors are, which are the same types of people that lose money. As you can see, right now, we are seeing record amounts of shorting in the market that we haven't seen since 2008. Shorting is typically when people are obviously betting against the market. And when people are putting so much bets against the market, at some point the market is going to bottom because there are no sellers left anymore. The volatility we're seeing in the market today is primarily driven by short sellers and people selling their positions in anticipation of a further decline happening in the market. And at some point, we're going to run out of sellers. As you can see, the average return following a 20% decline in the S&P 500 has always been in the positive over the past 100 years, even though obviously in the short term, it looks like the market is never going to bottom and that we're never going to see some sort of relaxation. But the reality is that is exactly how the market behaves every single time we see a correction or a bear market. And even if we have seen the end of the world coming up through World War III, a pandemic, a freaking global financial recession, a tech bubble, the market has still always recovered. And if you dollar cost averaged during those corrections, you always came out ahead given enough time. And that is precisely the situation we are seeing right now. As you can see right now, we're going through a very aggressive downturn. On average, the bottom of the market or the main move of the market within the first percentile often happens until the 8th month or the 9th month. But in this case, we're seeing that happen already by month 5. What this shows us as is that there's a liquidity problem in this market, and that is causing valuations to come down even more aggressively. Now, sure, in the short term, the market could bottom and then rally and then go down even more, and we could not bottom potentially until the end of the year. But again, as an investor, that's not our job. Our job is to buy quality assets in companies you believe as the market goes down. Because remember one thing, the rally that takes us out of the bear market or that eventually signals the bottom is going to look exactly like a fake rally that people have been talking about over the past couple of months. People have been talking about dead cat bounces and a fake bull trap in the market. Well, guess what? The market is going to rally just like that when we hit the eventual bottom. And so who knows when the bottom is going to be? And nobody on Twitter or YouTube definitely knows where the bottom is going to be. And so in my opinion, you guys should not listen to all the people on Twitter telling you that the market's going to go even lower. They're showing you all this scary data that's showing us that the market is going to get doomed. We're going to go into depression. All that is simply fear mongering. And these people have nothing better to do because their job is just to follow what the crowd is doing. They want that short-term gratification. As you can see right now, we are going through one of the worst declines we have seen in the market since 2008. In 2008, guys, we were going through a financial crisis. We had hedge funds and banks literally collapse like Lehman Brothers, and the real estate market was in a bubble. Unemployment was going record highs, and we were seeing job layoffs every single where. We were not seeing 18%, 10% layoffs like we're seeing with Coinbase and Tesla. We were seeing mass layoffs where people in the middle class and even in the upper class were not able to feed their families, and they got laid off, and their wealth got absolutely destroyed. The difference is today we're not seeing that. Today we're simply seeing a correction from an overheated market throughout 2020 and 2021, obviously which was driven by low interest rates and a lot of money supply in the market. And the underlying economy, because of that money supply, is very strong. It's just that asset prices got very overheated, and that pushed inflation high, which means that the Fed needs to automatically correct the cycle a little bit, and we need to relax so that we can bring that inflation down. On average, the percentage decline of the S&P 500 right now is almost 25%, whereas the NASDAQ is at around 35% right now. And as you can see, that is precisely the range in which the percent decline on average has been over the past 100 years in the biggest and baddest bear markets that we have seen. And on average, as you can see, the days from down 20% to bottom falls right in that 131% day range. And now in the S&P 500, we have hit that around a week and a half ago. And on the NASDAQ, we hit that about 2 months ago. And 2 months is obviously around 60 days. And so I hope that puts into perspective the severity of the current market crash and where that could head us. Sure, the rest of the year could just be sideways and we could be going down even lower. But again, as an investor, that's not my job. I see that as an opportunity. I don't want to be the one that's fear-mongering, telling people not to buy assets when 2022 could be the best year to acquire assets in the entire decade. And I would rather miss out on potentially nailing the bottom than never buy into the market because I'm too scared of the market going even lower. And I think that is exactly what we need to preach as retail investors. Here's another chart that kind of shows the capitulation side of the market reaching a potential climax. We've heard about capitulation many times, and I agree, we need the capitulation to really have the market rally higher. And as you can see, in terms of asset manager positioning, equity futures are seeing the highest amount of outflows we have seen since 2020. And before that, since 2015, which is when we had this massive sideways action in the S&P 500, where the market did nothing. We were having an interest rate problem. We were having potential fears around Ebola and the virus and the epidemic happening from that. And guess what? The market still ended up recovering. And so, although, yes, this doesn't mark the bottom, if we stay in this range for a long amount of time, that's telling you that we are seeing good buying opportunities. No matter what valuation metrics people use, the S&P 500 is still in a very attractive phase to be a buyer for. Not every single stock you buy is going to succeed, but if you just buy the index, especially if you're looking to retire within the next couple of decades, this is a great buying opportunity. And obviously, the last time we saw all this capitulation was in 2011, where we heard fears about this double dip recession happening. And as we've already seen, that is precisely not what happened. And this also sets into focus an important aspect. The fact that people always see the rallies after a bear market or a correction to be fake, right? You see this rally right here after 2008. Everybody called this to be a fake rally. Nobody believed in this. And that is precisely what caused this capitulation. People thought when this crash was happening that we were going into a double dip recession and that it was a fake out. But clearly that's not what the case was. Because guess what? If you're not going to buy the dip when we're in this recessionary period, you're never going to buy the dip even if we enter this expansionary period. Because you're never going to have that signal that shows you that we've officially hit the bottom. You're never going to see the good news come out until the market is already overheated and we're already near the top. That's what happened in 2021. Nobody was buying stocks in 2020 when the market was crashing. But all of a sudden, when the market was all-time highs, everybody plunged their money into the stock market with their stimulus checks and whatnot. And at the end of the day, that's what caused this market bubble to happen in the first place. And now we're seeing that recessionary period, and now nobody wants to buy again. So again, don't listen to the crowd, in my opinion. Stick to your discipline, stick to your strategy, and just remember that in the long term, your assets will eventually start to rise because that is essentially what drives the market. The market is driven by productivity and technical economic growth, not interest rates, not inflation. All that stuff is simply short-term stuff that dictates the short-term cycle. Whereas the long term, that is dictated by long-run economic growth and productivity and betting on America. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below what you guys are doing in this kind of market, and I'll catch you guys in the next one. Take care.